All right. So hey Sam, how you doing?
How you doing, Rodman? I'm doing good.
I'm good. That's good. That's good. So this is episode one of Robin Talks. It's great to have you. You're always in the office. It's really appreciative of you being here. If you don't mind, could you introduce yourself and let the people know who you are?
Yeah. Sam Cioffi. I'm a loan officer for New American Funding. Um, I'm a preferred lender for Rodman's company, Fave Realty. I'm always in the office. So yeah, we decided to get on and talk about mortgages and kind of, you had some questions you sent over, and I think it's good. I think it's good to, answer some of the questions people have because, no one teaches mortgages, so
Yeah.
it's good.
Yeah, definitely so. And again, I just want to give you your flowers whenever you're in the office. You always give me information, whether that's on the fly or if I have a question. So being around you, I always tend to learn something. So I just want to give you your flowers, bro.
Yeah, I appreciate that. Thank you.
Yeah, man. And so I broke down the questions in sections. So first is about real estate, realtor relations, questions for investors, and obviously for first-time home buyers, because that's probably the majority of people that's probably gonna watch, right?
Yeah.
But like I'm a realtor, like as we all know, in the Brooklyn area in New York, and I also work in Queens and Long Island. And you're one of my favorite lenders, my man. So so let's start there. So based on what you would think, what are the qualities you look for when looking at a relationship between a lender and a realtor?
Yeah, so I think the relationship between, the favorite agents that I like to work with is it's a team, right? So
Hmm.
an issue I see with like a lot of agents is, a lot of them are making calls off the leads that we provide or getting leads through Realtor.com, Zillow, whatever.
Hmm.
And what where I see it, issues arising is they'll talk to a client, talk to them for a minute, 30 seconds to a minute, have their number and name, and just kind of text it over to me saying, hey, this person wants to get pre-approved. Now, the hard part about that is, when you call them up, it's essentially just cold calling them again. So
Right.
they don't remember the realtor, they don't know who I am. So there's no kind of warm introduction and giving the client that opportunity to know who you are so you get to know a little bit of information about them. So it's easier for me to come in, understand a little bit about them, and then be able to help them the best I can. Like the best realtors that I work with, they vet the client before sending them to me like a little bit. They take that
Yeah.
extra 5 minutes to learn their situation, learn, what they do for work, the areas they want to live in, what their goals are. So when I'm going in, I'm not totally blind. And it just leads to building that better rapport. It gives you that much more of a chance to retain the client and just make, not slow down the flow of things. We
Yeah.
have leads coming in every day. We have people referring us business, but it's good to know that the people that we do schedule those appointments to talk to are somewhat qualified. It's not your job to qualify them the whole way through, but just to kind of know that they're not totally not qualified at all, because that just makes the flow easier, gives us the opportunity to get to know them and just work better as a team together. So I'd say the realtors I like to work with are ones who just kind of vet the people a little bit more, build a little bit rapport. So when I come in, it's that much easier to have that conversation, get the information I need to get them pre-approved.
Right. So essentially, the relationship doesn't start always with the lender, depending how it is. The relationship starts with the realtor and the client. So if the realtor doesn't have a good relationship with the client or the buyer, and we try to pass it forward, we can be lost in communication, right? Uh, I'd like to, for example, we're working on three deals now together,
Hmm.
two purchases and one a refi. That one deal, Lou, I don't want to give the full
Yeah.
name, but yeah, Lou, he had a prior lender. They went through a little bit of, maybe they did have a decent relationship, but the communication just wasn't as clear for him to understand. So
Hmm.
now when we put in the offer, he's wondering why he has to put down more than 3.5%.
Yeah.
So when it,
And that also comes to taking a complete full application up front from the lender side, you know.
mhm,
Like realtors, it's easy to get a license to do this job, but
mhm,
getting licensed and doing the job are two completely different things.
yeah,
And there's a
right,
lot of lenders right now who could pass the test, but they don't know the intricacies that go into lending and the guidelines that we have to follow. And they're throwing out these pre-approvals that are essentially just fake. They're just words on a piece of paper. And it's really terrible because you're putting people's deposits at risk. People are
yeah,
putting 30, 40, $50,000 down, and with the assumption that they're going to be approved for this loan because the lender told them that they were. And now, weeks, months go by, the seller's waiting, the attorneys are waiting, everyone's like, what's going on? And they're getting fed up, and now they want to take people's deposits. So
yeah,
it's so important to just take a complete app, work with someone who's experienced, who has a good team around them. Like my team at New American Funding is one of the top producing teams, not only in New York, but in the United States. So the amount of volume we see every week, when some LOs are taking 2 to 3 apps a week, we're taking 20 to 30 apps a week for each LO. So we just have that experience and we have a team of support behind us. So if a deal comes to us and we give it the okay, that deal's going to close. Some deals are trickier than other. It takes a little bit more time to go through all the necessary documentation, but you know that when you work with us and our team, we have the experience, we have the bandwidth, and we know what we're doing and how to do our jobs.
right. That's really important because some people, even realtors, and they just see the end. They just see the commission. They don't see that when you're purchasing a home, this is a lifelong thing for the buyer or for
Hmm.
the seller. So it's more about understanding what what the client needs. And when they feel like you understand them on a deeper level and you're not looking at it as just a sole transaction and you want to help them, they can feel that energy. And I think that's when the communication goes through with the realtor and then with the lender, and then it kind of eases its way to the closing day. So like you said, it all weaves itself together. And
Hmm.
you kind of brushed up on my follow-up question, like what are the red flags that we should look for when we're looking for if the buyer is coming with financing, what are some red flags that you say to keep an eye out for that could derail the deal, like you said, like faulty pre-approval, stuff like that, I'm assuming.
Yeah, I mean, just getting them vetted by the lender.
Mhm.
If like the questions we ask on an application are pretty straightforward. How much money do you have saved up that you were going to use for the down payment, and
Mhm.
and what you do for work? Those aren't questions that are very like, oh, I gotta find that. Like, you know where you work, you know how much money you have, you know what you get paid. So it's like when you talk to somebody and they're like, oh, well, I've been kind of doing this and that, and oh, I could get the money. Oh, don't worry about the money. Well,
Mhm.
we're about to lend you $500,000 to $1 million.
Right.
Yeah, we care about the money. We these questions aren't, we're not asking these because we want to know your business. We're asking them because you're trying to purchase a home, and this is the process to purchase a home. And I always know, like, I've spoken to so many people, so I could tell in the first minute to 2 minutes, like, is this person for real, or if they're just kind of, you know, they're just kind of want to talk and see what's going on, and
Right.
maybe they just have no idea where to start, and they just want to ask those questions. But people who are kind of secretive about their situation, that's a red flag for me because you have to go and continue to make these payments for 30 years or till the house is paid off. This is serious stuff. It's not it's like going to an attorney and getting into legal trouble and needing to explain your situation. You're not going to get anywhere by lying. We're
Yes.
not here to think negatively or have any type of wrong ideas towards your current situation. We just need to know what's going on so we could properly evaluate and help you and not waste anybody's time.
Yeah, I think that's really important because, like you said, you can get a faulty pre-approval, and then we put in the offer, it gets accepted, and then when it finally comes down to putting down the down payment, maybe you do have the down payment, but you find out that you're not approved for the loan, and now you're risking your down payment because you went online and just printed something up, or you went to somewhere and they just gave it to you just for potential business, and now you're stuck between a rock and a hard place because you didn't want to go through the proper channels to get the pre-approval and
Mhm.
to do the right thing, which is typically the right thing is maybe a little bit more difficult, but it's the right thing for a reason.
Yeah.
So when you explain it like that, it makes perfect sense.
Uh,
So
it's a little more work, but
mhm,
it's going to affect the client down the road because you could take the easy way and just kind of call up one of those rock and more like I don't know, but you
mhm,
call them up and they'll just print you out something just so you could go shop, and then
mhm.
it gets you in a tough situation down the road, and you don't want to be in that.
Yeah, and we had clients like that before, and luckily enough, he was able to save them. But they could have avoided the whole thing if they just went through the proper channels. So moving now to investors. So, like baby investors, people who want to get into investing, they have questions, right? Based from what you would think, would you say a good financing options for investors if they're trying to start out or if they're trying to scale their portfolio? What would you say would be options they could look at?
I mean, there's a ton of options, right? There's
Yeah.
DSCR loans, there's HELOCs, there's hard money loans, there's doing the investor conventional investing routes.
Hmm.
It really depends. It really depends on where you're currently at, because some of the products they require you to already own property. Some of them require you to already be an experienced investor. I would say the easiest way to do it is to go through like the conventional route through wait 1 second.
Okay.
Wait, I'm on a meeting. So yeah, like Fannie, Freddie, they have investor channels, so you could, go that way. I'd say that's the easiest for investors to get started.
Hmm. Okay, yeah, that's good. I think so it primarily go leans back into speaking with a lender who understands what they're looking for, and then looking at their situation, looking at what they have and what they may not have, and kind of plugging in the parts to kind of make it work. Is that safe to say?
Yeah, like if you already own a home and you're trying to buy a second one, a lot of people will take a home equity line of credit.
Hmm.
That would be the easiest option. That's something like if you see yourself flipping a house short term, if you're gonna pay it off quick, I would go the HELOC route.
Hmm.
You have a bunch of equity in your home, and you're gonna hold it more long term. You can do a cash out refinance. Um, if you're trying to flip a house, hard money could be good sometimes. Their
Right.
interest over a short period of time. So it depends on the goal and what kind of house they already have or what type of house they're looking at. There's different options, and it really depends on,
Yeah.
you know,
The type of investor too.
yep.
Yeah, like a flipper or someone who buys and holds. It's
Mhm.
different strategies there, right?
Yeah, like DSCR would be more buy and hold. You're putting down 20 to 25%, and then as long as the rental income covers the mortgage, you qualify for the loan. So that
Okay.
that's popular now. You know, that could
Mhm.
be a good option too. So yeah, it's just a bunch of different products depending on your goal.
Okay. Yeah, I know when they hear that, they're like, ding, ding, ding. This might be able to happen. Maybe we
Mhm.
can do this. Yeah. I mean, I guess that kind of leans into the underwriting process, right? I would assume, based off the situation, based off the goal, based on what product they plan on using. I'm assuming the underwriting process would be a little bit more stricter, or is there a difference between saying investor looking for a property in the underwriting process for a multifamily versus a person who's buying a primary residence? Is there a difference between the two?
Yeah, so on a primary residence, the underwriting guidelines are going strictly off your income and your assets, and it's going off your job history or your business income. When you're doing it for investment properties, it's off the income that the property is going to generate. So they're really just looking on at like rental appraisals, what they see each unit getting, and
Mhm.
what's the value of the property. They're not looking too deeply into your personal finances, more the finances that the property is going to produce.
Okay. And would you say what what would you have some tips for investors looking to secure financing for a multifamily property? Um, Obviously, it's a different set of requirements for it. Um, but is there any tips you would that you would say it's for, or is it based off each individual and what their situation is?
Yeah. I mean, so the biggest tip I would say is have everything in order from the start. You know,
Mhm.
a lot of investors will come to me and they'll say, "Oh, I have this property that I found. I want to put an offer on it." But their money's not all together. It's in they're getting gifts from partners, or not gifts, but they're getting money from different partners and different places, and you're gonna get the best deal for moving quick. And if you have to take 10, 20 days to get everything in order, your credit, your down payment, everything together, you're going to lose
Mhm.
that deal. So
Yeah.
you have to go in with everything already together so you could jump on those opportunities and not waste any time. So that's the tip, have your money in the bank, ready to go. Don't
Mhm.
have investment accounts that you need everything in line. So when you find that property, you could submit an offer. And then that's where you're going to get the best deals
Okay.
by moving fast.
Okay. So investors, you heard that. You have to have your ducks in line. You have to cross your T's and dot your I's before you actually shoot from the hip. But again, when you have a lender, they can tell you this on a personal basis because everyone's situation is a little bit different and the way that we approach the situation is a bit different. So you want to have a lender who has and a team who has a broad who has information about what you're trying to do, so that way they can present to you possible ideas and options that you may have. That's very key. This is I'm happy for investors. That's something I would like to do as well. But I have a special place for my heart for first-time home buyers, right? Because as we just discussed, this buying a home is for most people the biggest investment they will make in their lives outside of maybe their kids' college tuition, right? But they probably would do a refinance on the home if they don't have, that's a possibility. But when a person buys a home, it's a whole lot of emotions that come in there. You know what I mean? It's not just a transaction, you know, it's when somebody can start a home, can start a family, can build community sense. They they can grow old in the home. They can create generational wealth. They can become the first time home buyer can become an investor if they so choose, you know, or
Yeah,
but
investment loans require you to own a property. So you buy your first home, then you get into investing. You need a place to live first.
yeah, and and for a lot of people, that is once they buy a home, their life direction suddenly diverges into something beautiful. For that first time home buyer who has all the questions in the world and they're probably Googling it just to get a bird's eye view of everything, but they're gonna need to talk to us. What are the first steps a first time home buyer should take when starting the loan process? Like what are the things if they came to you and said, I want to buy a home, Sam, what now? What would you what would you say to them? Okay, this is what you do.
Yeah, so the first thing is taking an application from them, finding out their current
Mhm.
income. situation, what they're doing for work, how long they've been working. I mean, a mortgage approval gets based on three things: your credit, your current, so that doesn't just mean your credit score, it means the debt you have, car payments, leases, credit cards, student loans, income, how much you're making, and your employment, how long have you been working.
Hmm.
The banks require you to have 2 years of income history. So we're going to dive into where you work, how long you've been working, how you get paid. Is it hourly? Is it salary? Are you working? Are you self-employed? How long have you had your company? And then your assets. How much do you have saved? Where is that money? Are you pulling from retirement accounts? Do you have it all in a savings account? Is it spread amongst different accounts? Are you getting gifts? Because there's different guidelines that require you to get gift letters, and you have to transfer money a certain way without underwriting, putting red flags on your file and saying, hey, where did this money come from? Now we need extra documentation, and then it slows down the process. And which takes time, and if you want to meet, you have to meet your deadlines to protect your earnest money deposit. So all these things are important, and that's the first step, is really talking to the lender and letting them get a full picture of everything so they know how to guide you and lead you in the right direction so the process goes smooth.
Okay, okay. So they would have to have some form of income. They would have to have some form of saving. You said the job history has to be about 2 years.
Yeah, two
Job
years
history.
what we look for. So if you've been working for the MTA for 20 years, you're fine. If you've
Yeah.
been working a couple different jobs, you have a part-time job, you have gaps in income, that's where it gets a little bit trickier. And you have to really piece that together for the underwriters to meet the guidelines that Fannie and Freddie, the two government lending institutions, put in place. Um, you have to paint that picture because it's to show that you had 2 years of income, because we want to show that you're going to be able to pay this mortgage off for the upcoming years and that you have
Mhm.
stable sources of income and you could pay the loan back.
Okay. Yeah, that makes sense. You
Yeah,
have to show you have they would have to show that the money that they're getting as a loan, they have the right resources and the capabilities to pay that back. They have to show that. Uh,
exactly.
I mean that makes a lot of sense. I don't
Yeah,
think
a lot of guidelines that are set are common sense guidelines. Just the way you have to collect the documentation and paint the picture, because everyone's
Mhm.
so different. It's pretty straightforward, but the way everyone has such a different situation that
Mhm.
it's our job to paint that picture to the underwriter and prove to them that they're eligible to get the loan and they have the means to pay it back.
Mhm. I like what you said, paint the picture. So it's not a cookie cutter approach.
Mhm,
It's a little orchestra where you're like, okay, we have this, we have that. Let's see how we can put that together and make this make sense, if it can make sense, you
mhm.
know. So I like that you said it's painting the picture. So I know there's different options for buyers. You discussed it before. I know a lot of buyers will be doing the FHA, first time home buyer loans. I think that's really very powerful for a lot of people to buy their first home. That's a big deal.
Mhm.
The VA loan for veterans, and the conventional, which is it may depending on who it is, right? But those are the three options I would assume something that they would look at. Could you explain to us what a FHA, VA loan, and a conventional loan is to the people who don't know?
Yeah. So FHA is the Federal Housing Authority. It's a program that lends money to people with credit that might be a little bit lower. You could come in with the minimum down payment of 3.5%. You could do it for up to four families. It's a good product, if your credit's not, in the best shape, it still gives people an opportunity to get a house with a low down payment.
Mhm.
There is mortgage insurance that's added to that. It's basically a tax that is added because you're not putting down a larger down payment, but it's the least restrictive product, and it has the easiest accessibility to first time home buyers. So it's very popular.
Mhm.
Conventional, usually you could go as low as 3%, but typically 5% is the minimum down payment. It's for people with credit over 640. There's still mortgage insurance. Sometimes it's a little bit less, but not always. Most people, 90, a good majority of the people are either going FHA or conventional. Um, and then depending on your credit, you're usually that's going to typically be the deciding factor whether you go FHA or conventional. Now, VA is different. That's for veterans. That has a 0% down requirement, no PMI or MIP, which is that tax I was talking about for putting down. Um,
Hmm.
you know, less money. But I would say that that's such a great program because you get all the benefits of a conventional loan with putting 0% down, but that's just the incentive that the government put in place because if you served in the military, you do have that eligibility to use that program.
Hmm.
So for veterans, I always recommend the VA loan. The DTI ratios are higher, no mortgage insurance, low down payment. It's really a great product for
Hmm.
the
Yeah, I wanted to highlight those two, FHA and the VA loan. The FHA is a lot of people tell me, "Hey, Raman, I can't buy a home." Well, why? My credit score is a 640. I'm like, well, with a FHA, you need above a 580.
And
And the,
500 if you put 10% down. So if
there
your
you
credit
go.
great, but you have the resources for a 10% down payment, you could be as low as a 500 score.
Right. So that's an option. And typically you'd have to put 3.5% down.
Hmm.
So you can control an asset for say it's 300,000, the 3.5 would be 35,000, something around that park, if my math is correct.
For how
Um
for 300,
300, yeah.
yeah, 12.5 thousand about.
Yeah. So I was double. But
But
yeah,
with closing costs also, the closing costs in New York State are going to be between 4 and 5%. So you're pretty about 25,000 is pretty spot on with the
mhm.
down payment and the closing costs.
There we go. Okay. But even still, with all those all the costs included, you're able to have an asset worth that much for such little down payment. It
Hmm.
gets you in the door.
Hmm.
And essentially, a lot of people, that's the thing. They say, "Hey, how can I get in the door?" And once they're in the door, they can go from there. So I think that's definitely very important. The VA loan, like you said, is 0% down for veterans and people in the military. That's very important. I'm working with someone in the military right now. He's a great guy. So those are the options that I would like to highlight for them. So if they're looking for programs, that's definitely important. So we talked about how the pre-approval works when it comes to first-time home buyers, what you might need. Could you explain the role of a DTI, a debt to income ratio? That's very important. Some of them might not know, so if you could explain it to them.
Yeah, so debt to income ratio, that's what the bank uses to let you know if you're qualified to take
Mhm.
out more debt,
Okay.
essentially. So if you have a ton of credit cards, if you have car payments and your debt is high compared to your income, the bank might say to you, hey, you need to pay down some of this debt before we lend you any more money.
Yeah.
You think you're overextended. So the debt to income, the ratios are set by Fannie and Freddie, the government agencies, and that's just protecting themselves from saying, hey, this person's already got too much debt. We don't feel comfortable lending them any more money. Now, a way to get your debt to income ratio down is just paying off debts, paying off cards, or increasing your income and having other sources of income. But those guidelines are just set to not have people overextended like in 2008 when people were taking out loans and not able to pay
Right.
back and then they foreclose and then it is a
Mhm.
other you know
Yeah, I
issue.
understand. Yeah, it's a big deal. It's one of the foundations. So like when someone's buying a home, we tell them don't take out any extra credit cards, don't buy a car. You can do that after you buy the house, but
Hmm.
before you buy the house or before you at the closing table to sign, you have to make sure everything is still the same from the point when you got the pre-approval to the date of closing because as I'm sure they check again,
Yeah,
right?
check right before you close.
Right. Okay. And we don't have much time. We have about 10 minutes left because on Zoom, just so you know.
Okay.
But what are some of the hidden costs, like you said, of home ownership that buyers should look out for, like we discussed, you said closing costs. That I mean, it's not really hidden fees. It's all put down on the
Yeah,
closing
I
disclosure.
mean, those aren't hidden fees. I would say the hidden fees are the ones that are after you own the house. You
Right.
know, remembering there's going to be utilities, there's going to be sometimes maintenance, landscaping. There's going to be
Mhm.
issues that come up if it's an older property. You might have to get a new roof or, boil
Right.
replaced. Like those are hidden costs that people sometimes just forget about.
Hmm.
And it doesn't really, and also just your monthly debts that don't show up on your credit. You have to just be prepared and account for all the things that come up in life so you can, after you own the house, you're not, struggling.
Right. And just for the audience listening, that's where inspectors come in to make sure that, anything that needs to be done, major things, is you're aware of, or you can talk with the seller to do those repairs.
Mhm.
Um, what would you say is a common myth about mortgages or lending that you would like to debunk for the audience? As a lender, I'm pretty sure you've seen a lot of things. And is there anything that you like to debunk? I mean, we kind of went over it, a few things, like you said, going through the proper channels. Um, but is there anything that like you would say is like a common myth about mortgages or lending?
I'd say the main one is that applying for a mortgage hurts your credit. When we
Mm,
run credit for a mortgage, it doesn't hurt your credit score. Some people
mm,
think the score is going to drop dramatically. When you do an inquiry a house, it drops your score maybe 2 to 4 points. So, maybe 5 points, but that's not enough to hurt your score and put you into a bucket that's going to give you a higher interest rate.
mm,
When you're applying for cars and credit cards and running your credit 15 times, that's when you're going to see your scores drop 10, 20, 30 points. But when you're just applying for pre-approval, a score drop of 3 to 5 points is not going to have any impact on your credit eligibility.
mm,
So that's the main myth I hear. Whenever I hear somebody, they're like, "Is this going to hurt my credit?" And tell them the same thing every time. No, it's not going to hurt your credit. You're going to see that there was an inquiry done. Your score might drop 2 to 3 points, but if you're at an 800 and your score drops to 796, nothing's going to happen with your rate or your eligibility.
mm. Thanks for sharing that. That was I think that's something that a lot of people hear. I do hear that every now and then. They think they know the system, but they may not really gather it all together. And again, that's where we come in as professionals to help guide them. That's what we're here for, so that's really important. I do hear that a lot. And I would say this is the last question. What's your best advice for first-time home buyers who are nervous about taking on a mortgage? What do you have any advice for someone who is saying to themselves, again, they have a little bit of cold feet as of anything in life where you step out of something that you're used to doing, but you want something more, something else. Um, from your perspective, is there any take on that if someone's a little bit on the edge about taking on a mortgage when buying their first home?
I mean, it comes down to if you're applying for a mortgage and I go and I run the numbers by you and you don't think that you're going to be able to continue to make those payments and you're nervous about that, it might not be the time to buy a house.
Hmm.
Might not be, you know, you should feel confident when you're buying a house that you aren't going to be overextending yourself, that you're going to be able to pay your bills. And if you just feel like, if you're really nervous that you're not going to be able to, it should be, you have to reassess your budget or reassess the home prices that you're looking at, or just wait to buy a home. If usually people are nervous for a reason. And if that's a concern to you, you need to, maybe pause your search or take the steps to strengthen, your confidence so you're ready to buy a home. Because if you're going to buy a home, you should be 100% confident and ready to own a home and understand everything that comes with it.
Mhm. Brother, I really appreciate the information you shared. You're definitely in this field and you have the experience to definitely help people in that process to get the pre-approval and to get the home. That's the most important part, to actually get them the home and let them have a smile at their face at the end of the day.
Mm.
You mentioned it in the beginning, but where can the audience look for you again? If they have any questions related to mortgages, where can they reach out to you?
Yeah, so you can get all my information on newamericanfunding.com / my last name, Sam Cioffi. I'm gonna put on my at the end of this video all my information so people can reach out to me by my cell phone or email. And then yeah, just that's really where I'm at. You know, my website, my phone number, that's the best place to reach me. I'm on some social media, and you can reach out to me there too. But yeah, just my number 516-960-8934. That's the easiest place to reach me. I always have my phone on me. I try to answer the best I can unless I'm busy and then I'll call you back. But I see all my messages, I see my texts. So that's where you're gonna find me.
Okay. And if they call me, I'll always tell them to call you. Sam, brother, man, it's appreciative of you. Thanks again for hopping on, man. I'm gonna see you in the office, man. That's what we
Yep,
do.
yep.
And I thank you for your time on a Sunday afternoon, my brother. And once again, you have a good afternoon. Thank you for the
All right.
information.
Thanks, Rodman.
All right, my brother.
All right. Bye.
Bye.